My name is Owain Chambers. I am a Senior Business Development Director specialising in capital markets for Lenvi. On a day-to-day basis, I'm primarily engaged with the investment community, whether that be through the banks, institutional investors, neobanks, challenger banks, etc., but also directly with the lenders. So my role and the role of a backup servicer is to engage with two sets of groups. One, the investment community, who's providing the investment capital, and the lenders who are originating the loans. So my role is very much outward-facing to those investors and lenders, building relationships and looking for new opportunities. In regards to the question of what is standby, it's a question that is often asked because it's such a niche product in the market space. So the really best way to think about standby servicing is that it's an element of an insurance product. So really what happens is in a typical trade, you will have a bank or institutional investor, challenger bank, neobank, and what they'll do is they'll provide a sum of money to what's called an originator or a lender. So the capital is being sent and they purchase assets. Now the assets in this case might be individual loans and individual loan agreements. But in essence, you're talking relatively big money transactions. You're talking everything from 1 to 2 million up to £1 billion transactions. Now the problem you've got in essence for those capital providers, those banks, those institutional investors, is they are committing those large sums of funds, but if something happens to that originator, there's no recourse back. So all that money is out and it can't really get back to themselves. So that's where the role of a standby servicer really comes into play. So the role of a standby, like an insurance element, is really there to protect those investment funds from those capital market providers, from those banks, from those neobanks, challenger banks, institutional investors. So really what we do is we would ensure that if something detrimental was to happen to that lender, we can safeguard those investor funds, everything from 1 million to £1 billion, for example, and we can swiftly return those funds back. And the way that it works from our side of it is we would look to secure the portfolio, put our arms around the portfolio, and make sure that, first of all, the funds can easily be returned back, but also that the end consumer, whether that be an individual, whether that be a business, so there's SME financing, there's consumer financing, there's residential mortgages, all of those different types of asset classes. Really what we're doing as well is we're ensuring that those end consumers, those end customers are all protected as well. So they won't see any change in the way that their loans are managed. They won't see any change in the way that they repay their debt. There might be some variations to it, but in essence, we try and keep everything as consistent as possible. Really, we're a lifeline for banks and building societies and institutional investors, etc., to be able to provide capital to lenders through a debt capital market raise with the comfort and knowledge and the peace of mind that should something go wrong, that we're there to protect and return the funds back. So that's what the role of a standby servicer is. It's protection, it's investment, it's there to ensure that those capital market transactions can be undertaken very successfully. Events over the last 4 years really has heightened the requirement of having a standby servicer. We've been involved with standby servicing for many, many years, and we found that prior to the global pandemic, it was never just a tick box exercise, but it was kind of an exercise that was taken to just ensure that things were being done, really. Make sure the investment was protected. Yes, that's fine, there's a backup servicer in place. What we found then during COVID, because during that period nobody really knew what a post-COVID world would look like, the requirement and the scrutiny of a backup servicer was really intensified. So we found, and I certainly found this myself, having real in-depth conversations with your banks, your institutional investors, your neobanks, challenger banks, along with the lenders themselves, because they also have a say in the portfolio as well, to make sure that we have the skill set to be able to support that runoff should the requirement for us to step in and service that portfolio be necessary. We can step in and we found a lot more scrutiny on our capabilities to be able to do that and perform that task. But then we're also seeing other events across the globe. So for example, the war in Ukraine, you've got the Liz Truss mini budget that also has a direct impact onto the marketplace itself. And because it has such a direct impact on the market, having a backup servicer, having one that's been invoked, having one that's tried and tested becomes even more paramount. And so we find ourselves in a position where we have been invoked and we've gone through this process and we are tried and tested in this process. So we feel that the scrutiny is getting ever more there, because these events are happening more and more. It's a more and more common event we're seeing at the moment. And we are there to try and mitigate that risk. So we feel that the requirement and the scrutiny of a backup servicer is certainly intensified since the global pandemic, but it's not letting up in regards to the scrutiny. And in my opinion, it's right that it should be scrutinized. It's right that a investor scrutinizes, well, how would you manage this part of the process? How would you manage the invocation? How would you manage the cash flow? How would you manage the customers? It's a right thing to scrutinize because it's such an important, valuable tool for the investment community that you have somebody that you can trust. And therefore, I feel the scrutiny is 100% there. Lenvi itself provides a multitude of different products. And as a standby servicer, you've got to be able to demonstrate your capabilities through different products that you're able to bring to market. So first and foremost, you need to be able to have a servicing solution to play. And we've certainly got that. We're currently servicing about 24 billion of assets under management in our Cardiff operational centre. So we certainly have the skill set to be able to service asset classes, and multiple different asset classes that as well. So you've got secured charges, second charges, unsecured loans, invoice financing, litigation finance, etc. We service a wide range of different asset classes. So you've got to be able to do that. The other area you've got to be able to do, and especially in today's fintech world, is you've got to be able to understand and deploy technology and understand how technology is deployed within an infrastructure and how technology is deployed within a certain lender's eco-landscape or technology landscape. And really, we have the fortuitous position by being a tech player and a servicing player that the standby servicing credentials and capabilities that we have is kind of a merge of the two strengths and two capabilities that we have within Lenvi. So where we see ourselves in the market is in a very strong position because we have the tech play, we have the servicing play, but we've also got the capabilities and understanding and the reputation now of actually being invoked. So when we say invoked, there's different terminology used in the market. In essence, an invocation event is where you have an originator a lender is unable to continue servicing the asset class anymore. We have to step in. We always typically contract 30 days. And we, within 30 days, have to take everything over. That's the cash flow, that's the payments, that's the bank accounts, that's the system, that's the people, that's the software. So you can imagine the scrutiny required to be able to do that. So therefore, being able to leverage and rely on our skill sets as a servicer, rely on our skill sets, knowledge as a technology provider, and we are the largest provider of technology in the UK, being able to rely on both of those resources enables us to be highly successful in the standby servicing space. So within the ABS space in particular, we would probably say we're by far the most dominant player in that market. We currently stood behind about £35 billion of AUM across the board, which is a range of different asset classes. And again, it leverages our relationships with our other parts of Lenvi. And we've also been able to identify additional asset classes for us to expand a lot more into. So part of the Lenvi family is we have the invoice financing risk mitigation platform called Risk Factor. It's an extremely powerful tool and can assess £60 billion of transactions at any one time, but it's specifically and solely for the invoice finance, invoice factoring market. And so we've got that relationship and that asset class, that product, again, that we can rely on should an invoice financing platform also potentially invoke. We've got the skill sets, we've got the knowledge from utilizing that. So because we have the technology play, because we have the servicing play, because we have the invoice financing specialty as well, and we are a merger of all three excellent products, we probably stand alone as being the best in class as providing this product in the marketplace, and has certainly enabled our growth within this product. This is by far the most common question we get asked. What does it actually mean to be invoked? And we find ourselves in a position where we can draw on real life examples because it happens. Now, I wouldn't say it's a very common aspect of the market. It doesn't happen every day, but it does happen. And so what it means to be invoked is where those original lender, that original servicer, is no longer able to provide the same service to those customers. Now, that could be through varying different reasons. It could be insolvency. It could be they've had a stop lending license against them. It could be that the business has financially underperformed and has hit certain trigger points. It can be for a plethora of different reasons as to why a backup servicer gets invoked. The backup servicer, when a trigger happens, it's not really for us to say this is when it happens. It's out of our control. We would just need to be there for when it does happen. And so a backup servicer's responsibility is to ensure that at any time, should the trigger event happen, you're ready to go. That being said, I'll withdraw on the last three examples that we can talk about really, because it happened relatively recently, is two of those invocation events, we had an idea it was going to happen. There's writings on the wall, you get to see this is going to happen, where business might be struggling with their repayments, they might be struggling with their contractual obligations to fulfill its obligation as a servicer and originator. The third example I'll give is one that was wholly unexpected. We were unaware this was going to happen. We got told about it several months beforehand that it may happen, but then we got told that it's all going to be fine and everything's going to be okay. So we kind of put it on the back burner, and then overnight then it went, and it went very, very quickly. We had to change our invocation plan overnight because we were aware that the 30-day invocation plan, and I've mentioned this already, this is what we typically contract to, wasn't really fit for purpose at that point. And so we had to redefine our invocation plan from 30 days to 10 days. So what it means is that we had to redefine our strategy at that point from a 30-day planned approach to 10 days, you've got to get the servicing over the line. And so that changed a lot of the dynamic, that changed a lot of the processing, but we're still very successful in its own right in doing that. We had communicated to all borrowers, we had taken all the data that we needed to be able to service that portfolio and manage that portfolio correctly. So there is a difference. Now, to be invoked, as I said, it is a relatively rare activity, but it does happen in the marketplace. The consequences of having an investment facility that is not protected kind of speaks for itself. It's multi-million pound deal that is out in the market that should something happen, all of a sudden you've got this money, you can't get that money back, and that causes some difficulty, especially in the investment community. I think the interesting thing about this marketplace is how it is directly impacted by a lot of external factors and future factors that you really can't take into account at this very one stage. So things such as the war in Ukraine, a global pandemic that was wholly unexpected, but also budgets, mini budgets, and how that can also have a direct impact on the capital marketplace and just general economics across the globe. But you also get things outside of that as well, even closer to home. So, for example, you go back to 2008, you had the PPI scandal, and obviously that went on for several years. And that had such a direct impact on the second charge market and general markets in itself. So you could see then how having a backup servicer becomes even more paramount by just ensuring that protection is in place. So for external factors, completely out of the control of the investor, completely out of the control of the lender, can still be directly impacted by a lot of external factors, as I've mentioned. So therefore, it's paramount to have that protection in place. And we've seen that more and more commonly now. We've seen a lot of potential invocations where this may happen. But as I've said already, we've also had 3 in the relatively last 18 months. And that itself goes to show the state of the market. We've been doing this backup servicing for quite some time, and we had 1 invocation prior to this point, 3 in the last 18 months. Now, I'm aware that we've grown significantly since then, and you've got more facilities, you've got more clients, you've got more potential risk that there's going to be invocations simply by sheer mathematics. However, we've seen a spike in conversations over this period as well. We've seen an increase in demand and an increase in scrutiny on our capabilities as a backup servicer. And I think that's just a nervousness of what the future markets will be because of things like the global pandemic, because of things like wars in other parts of the globe, and just how that has such a direct impact on each and every financial market that we find ourselves in. So even though the product is, and the invocation is still relatively rare, having that security, having the peace of mind, especially for banks, institutional investors, just provides them that guarantee that should something go wrong, it's all protected anyway. It's a very interesting question as to what the investors actually get from this. And I think there's many things that they get from this, if I'm being totally honest. I think the first one they get is peace of mind. especially the higher up the chain you go, the internal councils, etc., that the facility, for example, £200 million, £300 million, £400 million, is vast sums of money leaving banks. And it's a huge sum of money for any bank, any institutional investor to give out. So having that assurance that it's protected no matter what, I think provides them with a significant amount of peace of mind. The other area as well that it also provides is just a comfort level. And I think that's the other thing that we can provide, is just that sheer comfort that should something go wrong, we are there to protect it. I think it's best viewed as an insurance type product. It's probably the best way that a lot of investors might view the product, that even though it might be something that you don't ever foresee happening, you've got it just in case it does happen. And I think that's the importance of standby servicing. So next to the what would happen invocation, this is by far the most common question we find is, well, what actually happens? What would you do? And we have recently started running invocation masterclasses to law specialists and to investment communities, really identifying and walking through case studies of the 3 different invocation events. So what actually happens? What do we do? What are the pitfalls to look out for? Because I'm not going to sit here and say everything went swimmingly, because there are challenges. You are taking an entire servicing operation from one place to another, all to be done in 30 days. It is a difficult task any way you look at this. So the preparation leading up to that is highly imperative. What I would say about the invocations as well is each one has its own complexity. No 2 are ever the same. So in many ways, the smallest volume size invocation that we had, in many ways proved to be the most complex because of the lead up time to it. Because there was nothing to say it was going to invoke, then all of a sudden it did invoke, means there's no lead up time, means you've got to act extremely quickly. The largest invocation we had, 72,000 agreements, it's a £50-60 million portfolio, so it was a very sizable business and servicing operation being undertaken. In many ways proved to be the most straightforward in many ways. So you can't really base it on size, you can't really base it on volume, you can't really base it on asset class, because each asset class has its own complexities and its own simplicities in many ways. So each one has to be taken on its own merit. What I would say in regards to some of the things we talk about during these invocation masterclasses is things that could be done prior to an invocation event that might ease the processing. So for example, one of the invocations we had, due to the lender unfortunately going into insolvency, meant that we had to redirect the funds from one bank account to another bank account because the bank account was going to be wrapped up into an insolvency. So we had to redirect funds. Now, we were operating very, very quickly because of the runtime on this. As I've said already in this conversation, we always contract to 30 days, but we always aim to deliver above this. So this was an invocation which we managed to complete in 7 days. So during those 7 days, we had managed to redirect payments, we had communicated to all borrowers, we had taken all the information, we had recontracted with key third-party providers. And it was in a very different jurisdiction. It was in Germany. So in a jurisdiction that we know, but it's not like the UK, which is where we're based. So we found that by redirecting the payments, it was a very successful process in the end. But during that process, it became very complex in regards to utilizing other third-party providers. New bank accounts had to be authorized with payment providers and payment gateway providers. So because of that, it delayed a lot of the payment waterfall. And because of that, payment waterfalls get impacted, means all the other suppliers in the process is naturally impacted by this. So that's one thing I think that we bring to the table is we've seen these events, we've encountered them, we've experienced them, we have been very successful in our own right, each one of them, but here's the things that we found out. And that's just an example of one of the things we found out is that having a bank account that might have already been approved by the payment gateway would have significantly sped up the payment waterfall processing, and it meant there was no complexity then thereafter. So that's an example of one. I know that you've mentioned litigation finance was a question, and that is a niche asset class. It's not a very wide popular asset class compared to your consumer lender, your residential mortgage provider, which is a much more straightforward product in many ways because it's so widely used in the market. Litigation finance does not have that similarities to a consumer lender, and neither is the conversation, neither is the customer, neither is the processing. So What it comes down to really at that point, because you have such a condensed timeline and window to transfer everything from incumbent servicer to Lenvi, it's the amount of work you do up front. It's what you understand about that lender prior to that point. And it's so imperative that each backup servicer will dive into that lender and understand exactly how that operation is run, how that business is run, how processing of cash, technology, systems, servicing, how communication with customers is all managed. So we, as a backup servicer, can step in and replicate that exact same process as best we can. We've been highly successful at this sort of 3 times over the last 18 months. And we have seen that by doing that work, by doing our due diligence, has made this transfer process significantly easier. The invocation scenario I mentioned earlier, which is the overnight scenario, because we already knew the lender, because we knew the processing, it meant that we were able to redefine our invocation plan from 30 days to 10 days. And it meant that we were able to be successful in doing so. And if I'm being honest, we've been successful at the other invocations as well, delivering well ahead of the 30-day schedule. And a lot of that comes down to the work you do before that. It's imperative that you understand everything you can about that business to inform any form of successful invocation. So asset class is a key element of that, understanding the processing and the legal requirements of that asset class in that jurisdiction.